Hello and welcome to Fixed Income in the Markets by Mercury Partners Academy and Banor Capital. We are delighted again to have our regular guest, Francesco Castelli, from the fixed income expert at Banor Capital. We're both in London. Francesco, welcome.
Thank you very much, Marcello. Thank you for having me.
So it's August the 1st. We pass the half-year mark. It's, if you want a kind of a summary, we had important central bank meetings happening. Give us a little bit of a recap of what has happened and what we should be looking for the second half of the year.
Yeah, the first part of the year, as you can see, has been clearly in favor of credit products. So high-yield markets being the clear winner with spread contracting. However, we think the second part of the year is likely to be different. As you can see from the last bit of the chart, corporate bonds and government bonds, which underperformed in the first part of the year, are now recovering. So the second part of the year is likely to be more favorable for a duration asset and not for credit assets. And we see a number of reasons. First reason is spreads. Spreads have tightened a lot in the last year or so, but as you can see, both in the US and in Europe, they are failing to tighten any further. They are already very, very tight. And so they are already discounting a very optimistic credit view. The second reason is more linked to the economic cycle. We look a lot at credit surprise indices. These indices have been created, by the way, to trade the duration, so they're very important to us. And as you can see, around the world in the first part of the year, we saw economic surprises on the upside. So economies, on average, have been delivering data which were beating economic expectations. The last few months, however, as you can see, these expectations now have reversed, and so economies are growing slower than expectations. And this generally is accompanied by a rise in bond prices. The third reason is monetary policy. With the inflation coming down and the economic growth slowing down a bit, not collapsing, but slowing down, finally, central banks will be able to cut rates. The ECB already cut rate and mentioned that they can cut further after the summer. The Bank of England surprised the markets cutting rates, and the Federal Reserve still hasn't got there yet, but it was very clear from Powell's conference call that they are ready to cut at the earliest opportunity, which is going to be September. So we see probably 2 cuts for all central banks in the second part of the year.
Very interesting.
Of course, one first implication is that the dollar strength we've seen at the beginning of the year might become under pressure. As you can see, the trade weighted value of the US dollar has been very, very correlated with monetary policy expectations in the last 18 months. So a decline in the expectation for rates on the December 2024 future might imply some dollar weakness ahead in the next few months.
Perfect.
On average, we think so that the environment for fixed income assets is going to be positive for duration, positive for government bonds. However, there will be some sources of risk, and we see the main source of risk in our view is from politics. There are governments that are spending a bit too much, at least in the eyes of the financial markets, and it is very clear that financial market participants, the fixed income investors, have gone back to their vigilantes role. So the guardian of the fixed income fair value. Central banks are no longer that involved because they are doing quantitative tightening, so they're selling bonds. So the fair value of the fixed income market will be determined going ahead by market participants. You can see in France, where the new election failed to deliver a clear majority, a widening in spread versus the swap curve, because if you don't have a clear governance and you don't have a clear commitment to fiscal tightening, the market will punish you. But it's also a theme we are seeing in the United States. The United States, we know there's going to be a very important presidential elections, and apart from the left versus right argument, there's a more fiscal expansion versus less fiscal expansion argument. And this is very important in a country with a large debt and a burgeoning deficit. So also in this country, you can see, also in the United States, of course, they are the most respected bond issuers in the world, but this is another country where we will need to monitor the political environment because the long end is likely to follow the destiny of the fiscal deficit.
Thank you, Francesco, for this very sharp and to the point but precise recap. We thank you again, Banor Capital. We encourage all our followers, especially the students, to come to internship opportunities you can find on the Mercury Partners Academy webpage, and to keep following us for many interviews with the regular guests like Francesco and many other. You can follow all these in the social. We thank you again, Francesco and Banor Capital, and we'll see you soon for the next appointment with Francesco on fixed income and the markets. Thank you very much, Francesco.
Thank you, Marcello.